How do wealthy families set up their life insurance policies? Do they own their policies personally? Or do they have a business or a trust own their policies? The truth is, there's a lot of different ways to do it. What we're going to talk about today are the different ways that you can set up ownership of a whole life insurance policy. And then we'll also talk about what some wealthy families do when it comes to setting up policies for asset protection and also creating generational wealth. Let's start with the most common approach when it comes to owning a life insurance policy. So with all life insurance policies, we will always have these three terms: the owner, the insured, and the beneficiary. The owner is the individual or entity, as it can be a trust or a business, that has complete control of the policy. The insured is the individual that the life insurance is on, meaning when they pass, that life insurance benefit is paid out. And the beneficiary is the individual or entity that receives the death benefit proceeds when the insured passes. The most common setup is as follows. The owner and the insured are the same person. So let's say that Joe wants a high cash value life insurance policy, so he owns it. He pays the premium, he controls the cash value, he takes loans, repays them, does everything. He has complete control of this policy. Joe is also the insured, meaning when he dies, the life insurance benefit is paid out. Now, it is paid out to Joe's beneficiary, which could be one person, could be multiple people, if it is multiple family members, could be a business, really whoever he'd like, as Joe can adjust the beneficiary of the policy after starting the policy. So when it comes to the beneficiary, you can change that quite easily, which is nice. Now, the most common approach is to see a spouse designated as the beneficiary. So let's say that Joe's wife's name is Jill, meaning when Joe dies, Jill receives the life insurance proceeds. The proceeds represent the total death benefit. So if Joe has a $10 million death benefit, when he dies, that's paid to Jill. Again, this is the most common approach, meaning most people we work with are setting up policies in this manner where the owner and the insured are the same person. Let's talk about parents and children. So this is another very common approach or common setup we see where parents say, hey, I like this whole life insurance policy. I like how it just continues to compound over time. I'd like to get a policy for my child. This way, by the time they're 20 or 30 years old and realize what they have, the thing's going to be compounding at such a fast pace. So let's pretend that Joe gets a policy on his son, we'll call his son Bill. And the beneficiary is who? Well, if the insured is Bill, Bill can't be the beneficiary. The beneficiary is who receives the death benefit if Bill dies. Could it be Joe? It can be. Usually what we'll see with parents is that parents will make themselves the beneficiaries initially, knowing that in the future, they plan to change this. Now, because we're assuming this is a couple, what's usually common to see is both the husband and wife will be the beneficiary of that policy. Usually we see one owner though. You could have co-owners, but it's not common to do that. Now, in this case, let's say they get the policy on Bill when Bill is 2 years old. All right, so he's a little baby. And the plan is to get Bill off to a nice start, maybe use this policy to help pay for Bill's college tuition, or just give the policy to Bill when he's 25 years old or at a responsible age. Can you do that? The answer is yes, you can. However, there are some things to be aware of. So what we can do is transfer the ownership of the life insurance policy at any point in time. It's referred to as a transfer of ownership. Now, who has to sign off on this? Joe would, the existing owner, and then whoever the new owner of the policy is. Now, if we have a minor cannot own a life insurance policy. We need to be a legal adult. That means if we're starting a policy on Bill today, when he's 2, either Joe needs to own the policy or it would need to be trust owned. let's say that Joe's plan is eventually to transfer that ownership to Bill. If we're going to transfer that to Bill when Bill is 22 years old, let's say 20 years from now, is that policy going to have a gain? Meaning the cash value will be greater than the total payments Joe has made. The answer is yes, and 20 years later, it will be significant. So we said 20 years. Okay, when Bill is 22 years old. Here's what we want to be aware of. If Joe has paid $10,000 per year for 20 years, that's a total of $200,000. So the total amount paid, $200,000. If the cash value, let's say, is worth $300,000, which 20 years down the road, it's probably going to be worth more than that, but let's just say $300,000 for the sake of this example. If Joe transfers the ownership to Bill, Bill, as the new owner, when he receives this policy, will have to pay ordinary income tax on the gains. So anytime you transfer ownership of a policy, if there's a gain on that, it's taxable to the new owner, which is very important to be aware of. If it goes to a spouse, however, we don't have to deal with that ownership taxation transfer. So in this particular case, the gains of $100,000 are taxed to Bill as ordinary income. So if Bill's income was zero for that year, it means he's going to have $100,000 in income that year, and I'll have to pay taxes based on that $100,000. So if he's taxed at a 20% rate, then he's going to have to write a check for $20,000. Now, that $20,000 could come from the $300,000 of the cash value, could be a withdrawal, could be a loan, very easy to do that. So he has the asset to do that. However, a lot of parents don't like that, and they want to prevent it if possible. So one thing we see done with some parents is they'll set up a trust at some point in time, typically before there's a gain on the policy, and they'll transfer ownership of the policy from the owner, Joe in this case, to the trust. And then the trust is set up in a manner that will allow Bill, the son, to access that cash value. However, we always want to work with a good tax attorney in a case like this, because just putting it in a trust is not automatically going to waive any potential taxes. No. If I take money from the cash value of the life insurance policy through the trust, and then I just take it and use it for something outside of the trust, that could potentially trigger a taxable event. So there are some things we want to be aware of there. Another thing you could do is transfer ownership before gain. That's an easy way to do it. Before gain. If you're starting a policy on someone who's 2 years old, that's going to be tough to do. Now, with that said, if you transfer it after gain, we can also look at the amount of the gain, because what you can do is gift that as well. So up to whatever the annual gift tax is. I have seen that done before. So if Joe gets a smaller policy on Bill, let's say he pays $2,000 per year, and 20 years down the road, the gain is only $15,000. Well, when he transfers it, if he's able to gift some of that gain, all of a sudden that can help offset the tax burden that might pop up. So there are some things that you can do that we have seen done before, which is good to be aware of. All right, let's talk about the last item, which is what we see high net worth families do. There's a lot of different strategies here. I'll talk about two. We'll start with a very creative one that I liked a lot that has to do with asset protection. So this was for a family that has a current net worth well over $100 million. It's probably closer to about $200 million today. But they have a very large life insurance policy on the husband. Here's how it's set up. They have a trust, but the trust does not own the policy. The trust is actually held outside of the U.S. That's how their tax attorney set this up. Then when we look at the owner of the policy, it's not the husband. Let's pretend that the husband's name is Joe, just to keep things consistent. The owner of the policy is an LLC that was set up in the state of Delaware. Why it was set up in Delaware is because Delaware has some very favorable asset protection laws. There's a couple states that are more favorable than others. Texas is another. I know Alaska used to be. Talking with a good tax attorney and discussing your goals and such will help determine exactly what state you're going to use. But the owner of the life insurance policy is the LLC. Then the insured is Joe. Let's call it Joe HNW, high net worth. All right. So he's the insured. Who's the beneficiary? Well, in their particular case, the LLC is the beneficiary. And the reason why is because that LLC is ultimately controlled by the trust. So when we set this up with the tax attorney, how it works is if anything happens to Joe, the death benefit proceeds, which are significant, are paid to the LLC, but ultimately the trust determines how those proceeds should be used. Do they all just go to his wife? Are they used for their joint business venture? The trust is ultimately going to determine that. But they're very young. The main purpose of them getting this policy and this particular setup was for asset protection. And then also the cash value was a heavy focus, being viewed as a safe place to put money. And when we looked at the growth and factored in the tax benefits, that was very appealing to them as well. That's a big reason why they did it. So that's one asset protection strategy. And next, let's look at a generational wealth strategy. And we're going to keep this simple. Usually what we see here, and what's talked about a lot, is having what is called an irrevocable life insurance trust, also referred to as an ILIT, own the life insurance policy. Now I want to hit on something here. When it comes to an irrevocable life insurance trust, a lot of times we hear that if you have a life insurance policy owned by an ILIT, let's do this. If an ILIT owns the policy, you can no longer access the cash value. Is that true? Not entirely. So if an ILIT owns a life insurance policy, let's say it's on you, we'll pretend that you're Joe, and you access that cash value. In many cases, you can still access it. Like you can go into your policy, request a loan, and you get the money. So it's not as if it's impossible to access. The thing is, if you access the cash value in a policy that's owned by an irrevocable life insurance trust, then the IRS may view that policy as an individually owned policy, specifically if you die within 3 years of using that money. So usually an irrevocable life insurance trust is a trust that is not owned within our personal estate. It's outside of our estate, and it's meant to help cover estate taxes that are due. So if I have a big old whole life insurance policy that's owned by an irrevocable life insurance trust, and I want to access the cash value for personal use, what would happen here is if I access it and then I die within 3 years of using it, the IRS could come in and say, wait a minute, you used this policy inside of the trust for personal use, the same way you would if you just own the policy as an individual. Therefore, you have triggered what is called an incident of ownership, which means the death benefit proceeds can be included in your taxable estate, which kind of voids the whole purpose of setting up that irrevocable life insurance trust. So, irrevocable life insurance trusts have a lot of benefits. Usually, they're great for individuals that have plenty of excess capital, money that they know they're not going to need to use, and they don't plan on using it, and they use a lot of that cash to fund a huge life insurance policy that is used to help cover estate taxes and be passed to the next generation. Now, with all of that said, let's talk about a simple strategy here that you don't need to have a high net worth to do. It does not involve an irrevocable life insurance trust, although you could have a living trust set up. Just a basic trust. It doesn't have to be an ILIT. The owner of the policy can be this trust, but it could also be you. So this is what we see happen a lot. Say Joe owns the policy. Joe is the insured. So if he dies, his wife Jill is ultimately going to get the money, but not directly. The trust is the beneficiary. So why families do it this way, and this is common if we see a family that does not have an ultra high net worth, meaning it's not above the estate tax limit, which is a little bit more than $20 million right now. The reason why families do this is it's a bit easier. So how it works is Joe owns this policy. He's the insured. The beneficiary is the trust. The trust has specific laws written in it. How it works is when he dies, the death benefit goes to the trust, and those proceeds, say it's a benefit of $5 million, a big one, that's paid income tax free. So now the trust gets this $5 million, which is meant to be ultimately used for Jill and the kids. Perhaps Joe said, I want $3 million of this $5 million to be used to establish new policies on Jill and my 3 children if I die. And then I want them to be able to use these policies for the same thing I am using it for, which could be acquiring real estate, investing in the family business, creating our own personal line of credit. With the life insurance policies, I'm referring to the cash value there. The laws of that trust can specifically state that. Why people do this and why Joe would do this in this particular case is because it prevents the kids in this example from going in there and just draining the cash value. The laws would state, well, before a child can get access to his or her cash value, so they can't go in there and just request a policy loan for $100 grand, it must be approved by the board members of a family foundation or the trustees. There's certain individuals that are named that state they must all simultaneously approve this loan to Joe Jr. or one of the children. And then they also set up terms that stipulate how and when he has to pay it back. What it really does is enforce responsibility, and it prevents the children and families in general just from blowing the money. Now, there's a lot more to it than what I just explained, but that is a high-level overview of what a lot of families do. This is a conversation I probably have with people every week when they're asking about what families do and ways you can set up a trust, why I would use a trust, particularly for the generational wealth piece standpoint, especially if I don't have an ultra high net worth, like what should I do? Well, I'll always throw ideas at you as far as what other people do, and then we can help you set it up in the way that you like it the most. So I hope you enjoyed this video. I had a ton of fun with it. This is one of the things I absolutely love to talk about. There's so much more you can do if you get into business planning and you own a company and you want to bundle that as well with your overall estate plan. I'm not a tax attorney by any means, so none of this is meant to be tax advice. We always work with your tax attorney, or we bring in one we would recommend if you don't have one. But anyway, I hope you enjoyed it. Let us know your thoughts in the comments below. You can also DM me as well if you'd like to connect. And as always, I hope this helps.